Okay, let's get right into this. I want you to imagine something. Imagine a trading system that promises you reliable income, and it only takes 5 minutes a day. Sounds pretty good, right? Well, now imagine that same system leads almost 1,000 people straight into a financial catastrophe, right before Christmas. This is the absolutely shocking story of a guy called Captain Condor and a $50 million wipeout.
Yeah, you heard that right. $50 million. And look, this wasn't some giant hedge fund taking a hit. We're talking about the collective life savings of a group of regular, everyday investors. Just poof, incinerated in the span of a single week.
And behind a massive number like $50 million, there are real people. This quote from a GoFundMe page that one of the members started really just says it all. I mean, we're talking about people's life savings completely gone in an instant. It's absolutely heartbreaking to even think about.
So, the big question is, how on earth does something like this even happen? How does a system that's promising reliable income end up causing a $50 million crash right at Christmas? Let's break it down.
All right, so the main guy at the center of all this is a trader named David Chau. He used the alias Captain Condor, which is quite a name. He was leading this private group of about 1,000 investors. And on Christmas Eve, their super high-risk strategy it completely imploded. And that's what led to that catastrophic $50 million loss.
Now, let's be real, 1,000 people don't just accidentally lose $50 million overnight. It makes you wonder, what kind of strategy could possibly promise the world but then fail so spectacularly? This is where the story, for me, gets really interesting.
So the sales pitch was, you guessed it, incredibly tempting. You've probably seen ads just like these on Instagram and Facebook, right? They promised a dependable, reliable way to make money in the market. And the best part? All it took, they said, was 5 minutes of your day. I mean, come on, that's a really powerful promise, especially for anyone just looking for a little bit of an edge.
The strategy itself is called an Iron Condor. Now, I know that sounds super complicated, but the basic idea is actually surprisingly simple. The best analogy I've heard is to think of it like betting on a football game. You don't care who wins or loses, you're just betting that the ball will stay between, say, the 40-yard lines for the whole game. As long as it stays inside that range, you win.
So here's the key takeaway. Captain Condor's group was basically betting on the market to be, well, boring. They were betting it would be calm. They were selling insurance against any big, wild price swings. So they'd set a price ceiling and a price floor for the S&P 500. And as long as the market stayed inside that little box they created, they collected the profit, the premium. The calmer the market, the better their chances of winning. And here's the thing. For a long time, it actually worked.
And of course, access to this supposedly foolproof system, it wasn't free, not by a long shot. Newcomers had to pay a pretty hefty annual fee, $5,500, just to get into a private Slack channel where Captain Condor would post his trade alerts.
But, and you knew there was a but coming, underneath this whole reliable strategy, there was a hidden, and I mean fatal, flaw. It's a classic gambling trap, really, something that has been bankrupting people for centuries.
So what was it? What was this fatal flaw? What was the hidden trap that could turn a profitable system into an absolute money-shredding machine, seemingly overnight?
It's a classic gambling strategy, and it's called the Martingale system. The idea is actually really simple. Let's say you bet 10 bucks on a coin flip and lose. Okay, next time you bet 20. Lose again, you bet 40. The thinking is that eventually you're going to win, and that one win will cover all your previous losses plus a little profit. It feels kind of infallible, right? But it has one giant, massive weakness. You need to have infinite money. Because a long enough losing streak will, without a doubt, wipe you out completely.
And this is what is so wild when you put it side by side with typical trading logic. Professional traders are always taught one thing: cut your losses early, manage your risk. The Martingale system does the exact opposite. It basically tells you to never accept a loss and to double, or even more than double, your risk every single time you're losing. It is a textbook recipe for disaster.
Okay, so now we have the two key ingredients for a total disaster, right? A super high-risk option strategy mixed with a fundamentally flawed betting system. So let's connect the dots and see exactly how these two things combined to trigger that final catastrophic crash. It really was a perfect storm. First off, Chau's trades were so big and so consistent that they actually became predictable. Other pros in the market could see what he was doing. On top of that, this all went down during a holiday week, so trading volume was super low. And the one thing their strategy needed, a bit of volatility, had dropped to a yearly low.
You add all that up, and then you throw in the Martingale system, which forced them to go all in after a few losses. Well, the stage was set for the final tragic act. And this timeline just shows you how fast everything fell apart. I mean, the strategy had been working pretty well since May of 2022. But then, in that week right before Christmas, they hit a losing streak. And being true to the Martingale system, what do? They kept doubling down. So on Christmas Eve, they placed their biggest bet ever, trying to win it all back in one go. But the market didn't cooperate. The S&P 500 rallied hard, blew right past their upper boundary, and just like that, they lost everything. So, what can we learn from all this? What does this story tell us about the wider market today? Because really, this isn't just a story about one group of people. It's a massive cautionary tale for this whole new era of trading we're in. Just take a look at this chart. The sheer volume of options trading has absolutely exploded since the pandemic. So many retail investors, everyday people, have poured into this corner of the market that used to really just be for the pros. It means that way more people are making these kinds of incredibly high-stakes bets than ever before.
And a big part of what's fueling this boom are these new, and I mean extremely risky, products like the ones Captain Condor was using. They're called Zero DTEs, which stands for 0 days to expiration options. And yeah, it's exactly what it sounds like. These things expire the very same day you buy them. It lets you make these incredibly short-term bets, basically turning the stock market into a daily lottery, where your margin for error is, well, it's pretty much zero.
And honestly, I think this quote from options expert Brent Kachuba just sums the whole thing up perfectly. He said, "It works incredibly well until all of a sudden you lose everything." And that's exactly what happened. I mean, that's it right there. The Martingale system, especially with these risky options, is a strategy that makes you feel invincible, right up until the moment it isn't. And when it fails, the loss is total. Which really leaves all of us with a final and pretty crucial question to think about. In this age of social media gurus and foolproof systems being sold to us every day, with all these powerful trading tools just a click away on our phones, how do you separate a real promise from catastrophic peril? The story of Captain Condor is one heck of a reminder that the promise of easy money, well, that's usually where the biggest risks are hiding.